In 2025, gold recorded an impressive rise of 64%. That's one of the best performances in its history, significantly outperforming the S&P 500 index, which rose only by 16%. At the moment, the long-term 30-year outlook may scare a lot of investors as the price seems vulnerable to a potential crash that we might see, and a lot of people are coming and asking me, what do you think of gold and silver? Where would it go? Would it go up? Would it go down? That is exactly what happened as the price fell from 5,600 per ounce to 4,000 within days, which was a drop of over 20%. That's the sharpest decline in gold's history. So on this chart here, you can see a 10-year chart of the gold. It is hard to judge the price solely based on the chart because one could easily say that even at $3,000, gold was already very high valued and had risen extremely sharply. Yet, from that time when the gold was $3,000 per ounce until today, that's another rise of more than 50%. This means that there are far more important factors than just price increases or declines in percentage terms. Regarding the recent drop that we saw in gold and silver, and even Bitcoin if you wish, this was completely normal and expected to have a correction. These are very normal market movements, and usually after a record rise, it is normal to have a record decline as well. We had Bitcoin hitting $126,000, which was new all-time high. We had gold sitting at new all-time high, rising sharply in 2025, and the same applies to silver. They are very specific, very logical, and historically proven, so it is important to understand the concept and that gold, silver, and Bitcoin do not fall in price because they are becoming too expensive. A collapse in the price of gold in particular occurs only when confidence in fiat currencies is restored. This is when we see this collapse in gold. Fiat currencies are currencies that are not backed by anything, and since 1971, all major currencies in the world have been fiat currencies backed only by promises and, most importantly, by debt. Right now, gold is exploding to the upside, and that's because confidence in the dollar and other fiat currencies is being lost. Ordinary people like us, institutions, and especially governments are increasingly realizing that the financial world is based on promises, and sometimes these promises break. That usually leads to major crises and huge changes. So now let's return to the main question: when does the price of gold fall? As I mentioned, the price rarely falls long term just because it has gone up too much. Long-term declines in gold happen only when three main factors come together in the picture. Positive real interest rates, so interest rates higher than inflation, a strong and appreciating US dollar, that's the second one, and the third one is restored confidence in monetary policy. And at the end of this video, I'll also share one fourth bonus factor that is crucial for understanding the price dynamics. Only when these three factors come into the picture and the bonus factor that I'll mention later appear, we can see a long-term decline in gold. And here I'm very specific talking about long-term declines. I'm not saying that gold will not drop 10% or 20% tomorrow or even more in the short term. It is very possible. Here we are talking about decades of decline, like from 1980 to the early 2000s, from 2011 to 2023. I'm talking about long periods of time here, not just overnight or 2 days, 3 days, not even a week. Even during high inflation, when fear is extreme and other assets fall, gold can also decline temporarily. But these are short-term drops, not structural long-term declines. The same reaction is observed in silver, but silver, of course, is much more volatile. Over the past 50 years, in about 90% of the time, silver has made larger moves than gold, and in both directions, ups and downs. This is because silver is much smaller market cap compared to gold, so capital inflows and outflows have a bigger impact on the price. And we saw silver recording a record high price in 2025 of around 200% increase just over a year. It was absolutely normal to expect and to see a record correction of 35%, over 35% just in days. That was very normal and expected. You have to remember that markets behave like a pendulum. The further it swings in one direction, that means the stronger it swings back. For example, if you look at silver, in 2022, it fell from $28 to $18 per ounce, a 35% drop over months. In 2020, silver fell from $18.5 to around $11. That's a nearly 40% drop in days. That's why here I want to emphasize, do not focus on short-term price drops. They are inevitable. They'll happen regardless of what you want. Instead, understand the fundamental forces that are driving the long-term trend, especially when it comes to precious metals. Now, let's discuss these three key factors determining long-term gold trends, because if you're holding gold, this will be important to you. Historically, what we've seen, gold crashed in 1980 after the Federal Reserve Paul Volcker raised interest rates to 20%. This made, of course, holding cash and bonds very attractive, which killed the gold demand at that time. Gold also fell after the 2011 because the expected inflation after money printing did not materialize. Globalization and financial system dynamics prevented inflation from reaching the real economy. As a result, gold's role at that time as insurance became unnecessary and the price declined. Today's situation, though, is very different for a few fundamental reasons. The first factor that we've got is the negative real interest rates. Real inflation is higher than interest rates, meaning money in banks loses purchasing power. When your money in the bank has less purchasing power, meaning you can buy less with it, this of course pushes investors towards gold, stocks and real estate, which strongly supports gold overall this setup. And that's what we have so far. The second factor is the weak long-term outlook for the US dollar. The US dollar in 2025 lost around 12-13% of its value. You can see that on the chart here. And that's why we saw massive runs for precious metals in 2025. That's one reason. The other reason is, for example, silver has industrial demand for it and there is not enough silver available. So apart from the weak dollar, there are some other prompts in holding precious metals. And global debt is extremely high right now. The US debt is over 120% of the GDP, making this Volcker that we talked about earlier style rate hikes impossible. It's not possible to have this kind of high interest rates. So high debt supports gold long term and weakens the fiat currencies. The third factor that we have is central banks buying gold and de-dollarization. Central banks have been buying gold for the past 10 years aggressively, at very rapid pace. And they are buying gold at record levels to diversify away from the dollar, especially after Russia's reserves were frozen. And many countries are moving away from the dollar system, which further weakens the dollar and supports gold. And now the bonus factor in all of that. The bonus factor is the geopolitical uncertainty. In times of high geopolitical tension, investors turn always to gold. And the world nowadays is becoming more deglobalized with growing conflicts between global powers. We have Iran, Israel, we have Russia, Ukraine, all these conflicts, and we have always US involved in that as well. These kind of situations and this kind of tension always supports gold. And the world is becoming more and more deglobalized. That also supports gold in long term. Finally, there are three possible future scenarios. Consolidation and volatility. Gold moves sideways in a range and cools off a little bit. It is also possible to see brutal corrections on the way, and in a bull market, drops of 15, 20, even if you wish 30% are normal. And the other scenario is a long-term bear market, but this would require painful fiscal discipline and political will, which currently doesn't exist. So I would say this scenario of long-term bear market is not really in the picture. We are left now with consolidation and also corrections in this bull market. Both are possible and both are good because long-term these corrections do not impact the fact that gold will continue rising. Remember that gold is insurance against fiat currency failure. Until confidence in monetary policy is restored with real returns and discipline, history suggests that gold will remain supported and will remain in a bull run looking for the long term. That's from me today. Thanks so much for watching. I'll see you in the next video.